You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
I think the entire valuation of the company is premised on the existing deposit Baptiste. And in fact, I think we're way undervalued on that basis. We trade at a multiple of we trade for about 5%. Our market cap represents about 5% of the project value as described in our PEA. Whereas companies at this stage in this market, base metal companies, are typically trading in the range of 15 to 20% of their project value. So we think we're way undervalued on the basis of Baptiste alone.
I'm Bill Powers. This is Mining Stock Education. Thank you for tuning in again. We're going to be speaking with Martin Turenne. He is the president and CEO of FPX Nickel, one of our sponsors. And Martin will bring us up to speed on what's going on in the nickel market, as well as the progress FPX Nickel has made thus far and plans to make in the remainder of 2021. So Martin, welcome back onto the program. And since we last spoke, can you give us some of the key things that have occurred in the nickel market to bring us up to speed, please?
Yeah, so thanks for having us on again, Bill, and it's good to see you. So the nickel market, had a bit of a decline actually in the first quarter of 2021 on some news out of Indonesia and some Chinese companies that are operating there on their ability to produce nickel sulfate, which is the nickel battery chemical, in a different way than was previously assumed could be done. So the market sold off a little bit on that, and I think in more recent weeks, what we've seen is nickel inventories have been declining. And I think the market has digested that news and realized it maybe isn't the game changer that some people feared it would be. And in fact, I think it's actually good news for the nickel market. One of the biggest risks for the nickel price for the nickel market going forward is actually that the nickel price goes too high too quickly. We want to make sure the nickel price stays at strong but moderate levels to ensure that there's no substitution risks. And I think that's something that people often don't think about when commodity prices go high. Certainly, a company like us, the nickel price trading around $8 a pound as it is today, we believe our project would be very profitable. And what we've seen in previous markets is when commodity prices run too high too quickly, it can end up actually cratering the market in the long term, which is not what we want to see.
Two of the primary uses of nickel, as you've informed my audience in the past, is stainless steel and also batteries. So what would be a substitute for both those applications?
Yeah, so for stainless steel, you can make different types of stainless steel that are less nickel containing and some that in fact include no nickel. Now, these are lower quality stainless products and so less desirable than the nickel-rich stainless. So that's one element of potential substitution. The other is with respect to the electric vehicle batteries. What we've seen in recent years is the battery manufacturers have been trying to engineer the cobalt out of batteries for several reasons. One of them driven by the fact that the price of cobalt is relatively high. And so if you can swap in nickel, which is what the trend has been, then you would rather have nickel in than cobalt for several reasons, including cost. However, if the nickel price was to run super high, you could expect that battery manufacturers might try to work out new technologies, not in the short term, but certainly in the long term, that might reduce the amount of nickel in the batteries.
But there's not a metal you have in mind that could replace how nickel functions in the battery right now.
Not as such. There are, more iron-based batteries that are seen as alternatives to nickel-rich batteries. But the iron-rich batteries, while lower cost, also have much lower performance in terms of the range for the cars or the charging time. So those are things that would mitigate against, I think, the wide adoption of that iron-rich alternative to the nickel-rich batteries.
It's often said that we cannot have the electrical vehicle revolution without copper, but you also say that nickel is the preeminent or ultimate battery metal. Could you elaborate on that?
Yeah, and at the end of the day, it's actually not me saying that. It's really the demand forecast for these metals by major mining companies and by metals analysts. Glencore had a very good slide in one of their recent presentations where they projected the demand for the metals that they are produce in 2050 versus the 2019 as the baseline. And what that showed is that they expect copper demand in 2050 to be double what it is today. Whereas for nickel, they expect the demand to be almost 4 times what it is today. And so, yes, copper absolutely benefits from electrification. But owing to the relatively smaller scale of the nickel market, nickel actually stands to benefit proportionally significantly more. And in my view, is therefore kind of, as you say, kind of that ultimate EV battery metal.
When you're looking at nickel investments, you have to think about where is it going to be refined? How is it going to be refined? The Biden administration is talking about U.S. domestic nickel refineries. How does this impact the industry as a whole and your project specifically?
Yeah, so the White House has come out actually just in recent days with some new guidance, a new report naming nickel as one of the three key critical minerals for the ultimate electrification of the economy in the United States. So that's nickel, cobalt, and lithium. And then there's some second order commodities, including copper. And so the Biden administration is recognizing the criticality of nickel supply, of securing nickel supply, if it wants to see the electrification of the US vehicle fleet, which from a regulatory standpoint, we can argue whether that should be kind of a regulatory push or not. But what we're seeing in governments worldwide is they are wanting to push economies towards electrification of transport. And so if you're going to have a US auto industry that's focused on developing fleets of electric vehicles, domestic supply of these materials, both in terms of mines and more importantly, processing capacity, is something the Biden administration has flagged as being critical. And what we've seen, I think certainly since the onset of the pandemic, is we've seen the trend towards regionalization of supply chains globally. We don't necessarily want to be beholden to supply of critical items that we need in our day-to-day coming from places that are far afield. So the current administration is talking quite a bit about working with allied countries, including Canada, for the supply of critical materials. And that means, of course, things like nickel. And that we believe should put a premium on the ability of Canadian nickel producers or nickel mine developers to sell into the market because of that kind of global sort of strategic push, those geopolitical considerations for the US.
So U.S. automakers are also moving upstream into battery production, and Elon Musk has telegraphed that that's where he wants to go with his company too. And is that just along the themes of what you've been talking about? This is all bullish for your product and who you expect to supply?
Yeah, so we've seen, in recent weeks, for example, Ford announced a joint venture with a large Korean battery maker to develop battery production facilities in North America. Again, so that there's that security of supply around the batteries that would go into the Ford vehicle fleet. And so that's a real, interesting signal of the importance that automakers are placing on moving upstream in order to secure batteries. And we think the next stage beyond that is actually for the battery makers and the automakers to have to think very seriously about, securing raw materials supply. Because you can't build the batteries, of course, without those fundamental raw materials like nickel. And again, that just speaks to, for FPX, given the scale of the nickel deposit that we have, the ability to produce it at a large scale for potential for low cost in an environmentally friendly manner, we think it puts us in the catbird seat. And it opens up the field of potential strategic partners for us beyond just mining companies, and now actually looking at potential collaboration in years to come with battery makers or car makers.
Martin, Waterton engaged Goldman Sachs to sell their nickel project in Quebec for hopefully $1 billion. Give us the details, like a little bit of the history here, and what's the significance of the asking price if they're able to get it? Specifically, how would it correlate back to what you're trying to do in monetizing your projects?
Yeah, so Dumont is a discovery actually that dates back, over 50 years, and it's located in Quebec. It's a large, relatively low-grade nickel deposit. In more recent years, it was owned by a company called Royal Nickel, and Waterton is a big mining private equity shop based in Toronto who acquired 100% interest in that asset. There's been, hundreds of millions of dollars spent historically on developing Dumont to the point where it stands today. And what you see now is a project that in previous cycles may not have sort of made it past the finish line. I think Waterton is of the view that it will get built in this coming cycle. And, they have targeted that $1 billion valuation, which I think, when you look at a company like FPX, our Baptiste deposit, We think that our project actually lines up very favorably, and in our view is actually a better deposit than what is there at Dumont in terms of having a lower cost profile, higher nickel production capacity, and a longer mine life. We think that $1 billion valuation for that Waterton is seeking for that asset bodes well for our company, which has a US dollar market cap of around $100 million right now.
And there's a parallel too in that a group was able to come in and buy a distressed asset and then monetize it. There's a little bit of that in your history, I guess, too, right? With what you have with Baptiste?
Yeah, it's kind of the eternal story, really, of the mining industry, where projects can get moved forward through a bull market. They then kind of have difficulty sort of accessing capital in bear market, and there typically is oftentimes a change in ownership and multiple owners of a deposit. And the people who really benefit through that cycle are those who buy at a low and are able to sell at a high. And that's kind of what we've done here with FPX. This project used to be in a joint venture with Cleveland Cliffs, a large US iron ore producer. They spent a bunch of money, almost $25 million US, to advance the project. We were then able to buy the asset out from Cliffs when their Canadian operations went bankrupt for under $5 million. In late 2015, really at the bottom of the cycle. So it was a very strategic acquisition, very well-timed acquisition for us. And, the next ultimate step for us will be to ultimately monetize the asset in that same way.
And Baptiste is in the Decar nickel district. Now, central that you're going to do this summer is the Van target. We talked about this last time, bigger footprint, higher grades on surface than what you're seeing at Baptiste. Remind us what you're going to try to accomplish here this summer.
Yeah, so the land package we control at Decar is very large. It covers 245 square kilometers. And within that, we have defined the Baptiste deposit. We've completed several mineral resource estimates and a PEA on that deposit in September of 2020, which shows the project is very robust at today's nickel price. Baptiste only covers about 1% of the overall land package at Decar. So there is a vast amount of exploration potential beyond Baptiste to discover other deposits. And the real prize is to discover other deposits that might be of a similar scale, but might be even higher grade. And so 6 kilometers north of Baptiste, we've identified a very large target called Van on the basis of favorable magnetic surveys, as well as outcropping bedrock. So the mineralization is sticking up out of the ground here over a very large area. In fact, an area that is larger than the footprint of Baptiste. And the grades at surface at Van are higher than what we see at Baptiste. This area had been previously inaccessible to us because of it being covered by dense forest. There's been logging activities in more recent years that have cleared the trees away. So this summer, we're actually going to be embarking on our first drill program at Van with we think, interesting potential for a brand new major nickel deposit discovery to go on top of Baptiste, which is already the third largest undeveloped nickel deposit in the world.
And that's 3,000 meters. Is that right? Am I recalling correctly?
Yeah, 3,000 meters, which is fairly modest in terms of the total meterage. But the style of nickel mineralization that we have here is very homogeneous, very consistently disseminated. And so we can actually prove up significant tonnage ore body, even on that relatively modest amount of drilling, because we are doing it on very wide-spaced centers.
And would it be too much to say that you could even have an inferred resource at the end of the year?
No, that's a possibility. I wouldn't kind of guide the market to that as such, but certainly we'll have enough data to be able to do some internal modeling and understand the beginnings of the shape of a potential ore body there.
If you experience success and you see the mineralization at Van that you desire, how does that change FPX? I mean, hopefully it would increase the market cap, of course, but does that shift attention to Van away from Baptiste? Can you work on both at the same time?
Well, yes, it really speaks to what our corporate strategy is, and it's a twofold strategy. The first prong of it is taking the existing deposit Baptiste and moving it from the PEA into the preliminary feasibility study. And that comes with a whole host of activities that are going to de-risk the asset and really demonstrate that it is as robust as the PEA suggested it would be. The other side of the story is that exploration at the Van target and also at several other targets that we've identified throughout the land package. And if we're successful at the Van target, and if we are able to define a deposit there that might be higher grade than Baptiste, it would certainly cause us to kind of consider what the appropriate development plan is. And if we've got a new sort of 1A deposit and Baptiste becomes 1B, that'll be a nice problem to have.
You, in your studies for the Baptiste deposit, you're focusing on supplying the nickel market in a low carbon economy, low net zero carbon. Talk to us about what progress you've been able to make. And I'm also intrigued and interested to learn, are investors recognizing what you're trying to do here on the ESG level?
Yeah, okay, there's a lot to unpack there. So first of all, we know that the mining industry is by its very nature a carbon intensive industry, right? There's a lot of CO2 emissions associated with mining and processing. And that's particularly true in nickel. And so what we've done is we've done some really good work to estimate what the carbon footprint of nickel production at our facility would be. And what that shows is that we'd actually be among the lowest carbon footprint nickel producers anywhere in the world. We think that's really important for downstream consumers, for battery makers, and ultimately consumers who are going to want to ensure that the materials that go into EV batteries were responsibly sourced and sourced in a way that is from a low carbon source. Because if the material that goes in an EV battery is dirty in how it was produced, it kind of really mitigates any kind of net environmental benefit from buying an EV in the first place. Beyond that, we've shown that we actually in our tailings have unique potential to sequester carbon dioxide. And that would actually potentially render our project carbon neutral or even potentially carbon net negative, which is pretty exciting and would definitely be the first of its kind for the nickel industry. To your point on investors, yes, absolutely. We are seeing genuine interest in this theme. I mean, ESG is now kind of on the lips of all really investors, whether they're ESG funds or not. We've seen generalist investors around the world, large pension funds and others, divesting investments that they might have had in things like oil and gas companies because of the associated ESG footprint. So even if you yourself are not kind of fixated on ESG considerations for your own personal investments, the trend is certainly there. And ESG or companies that have sort of negative ESG profile who are high carbon emitters are going to have a higher cost of capital, more difficult access to capital, whereas companies that are positioned in a better light with respect to ESG considerations that have lower carbon footprint, I think they're going to have easier access to capital and more investor interest. And we're certainly seeing that. We saw that definitely in the financing that we completed in April, where we raised $16 million from institutional funds. It's really the first institutionally backed fundraise in the company's history. And a lot of that was premised, based on our meetings with those groups, on people playing the EV battery metals thematic and really being attracted to this idea of EV battery metals that are sourced in a low carbon way.
How did that financing come about, Martin? Was it a case of you sowing the seeds through meetings and eventually it came back to you, or did you solicit that investment?
Yeah, it was really sowing the seeds rather through meetings. And, we've been fortunate over the last year to get analyst coverage for the first time from two Toronto-based investment banks, Cormark Securities and Paradigm Capital. And both of those groups were instrumental. That was actually a bought deal where they were seeing a lot of institutional interest in our story and kind of came to us and said that, there's an opportunity to raise a significant amount of money on fairly favorable terms, a straight share, no warrants, et cetera. And so we took that opportunity and have added kind of significant institutional ownership to our shareholder base for the first time. And we expect to see this story become more and more institutionally held, which I think is great for our retail shareholders who kind of can see opportunities there for the shareholder base to mature. And that allows retail opportunities kind of, ready, willing buyers should they wish to sell their positions as the company continues to advance and the share price goes up in due course.
And the share price has been trading a little below that deal where it was priced at. What's your commentary regarding this?
Yeah, we had some selling pressure actually from one of the Canadian funds that participated in that financing, where they were having to sell for their own reasons, a number of their junior equity positions. And so that was about 8 different companies that they were selling aggressively out of, actually, just in the last week or so. That position has been exhausted now. They sold that out. We had a particularly high trading volume day just over a week ago, That position has been kind of extinguished now, and we think of this as a sort of a temporary kind of buying opportunity for people to look at the stock and to be able to buy it at a level below where we financed at just recently.
All right. And Martin, as we kind of wrap it up here, key catalyst to look to is it going to be the drill results out of Van, the big thing that investors should look to?
Yeah, drill results at Van is going to be very important. Some other regional exploration news on moving some other targets to the drill ready stage as well, which we're quite excited about. That fundamental work on de-risking, including on metallurgy with respect to the main deposit Baptiste, as well as more news on carbon sequestration. We hope to be able to expand that, and we're talking to varying levels of government about accessing additional funding for that work. So that acts as nice sort of validation from governments as well to support that work and bring it forward. And finally, we'll also have some more work and news on our ability to produce nickel sulfate, which is nickel in the battery chemical form that's required for the EVs. So lots going on this year. We're kind of fully funded really over the next 2 years plus to execute on a whole host of fundamental project de-risking and exploration activities. So it's a pretty exciting time for us.
And what would be the biggest risk then? If there's not a funding risk, is it just lack of discovery? Would that be one of your biggest risks?
Yeah, I don't think that lack of discovery is really a risk. I mean, I think the entire valuation of the company is premised on the existing deposit Baptiste. And in fact, I think we're way undervalued on that basis. We trade at a multiple of we trade for about 5%. Our market cap represents about 5% of the project value as described in our PEA. Whereas companies at this stage in this market, base metal companies, are typically trading in the range of 15 to 20% of their project value. So we think we're way undervalued on the basis of Baptiste alone. Market risk, I think, would just be general risk around, junior mining, commodity prices, et cetera, but nothing we see as being specific to the company.
All right. The website is FPXNickel.com. Ticker symbol in Toronto, FPX, and in the States on the OTC, FPOCF. Martin, thanks for coming on the show and giving us an update of the nickel market and FPX Nickel.
Thanks, Bill. Great to see you.